Welcome back to the second half of the Future Show, ladies and gentlemen. We're less than 60 minutes from the cash open for stocks on Wall Street. We have, indices here, which are, for the most part, still mixed. Let's take a look at the ES, the NASDAQ, the Dow, the Russell here at the top of the show. We talked about how, we had mixed activity. That continues to be the case, and this is limited reaction, too, as well, to the PPI numbers, Producer Price Index, across the board. Whether you're talking the core here, ladies and gentlemen, or, there you can see it came in above estimates. The month-over-month, the core is 0.4. They were looking at the 0.2. PPI month-over-month also coming in at 0.4. They were looking for 0.2. You got year-over-year PPI 0.4 as well. And take a look at the core year-over-year. Again, just above estimates here, ladies and gentlemen. Let's get Alan Nuckman's take on it. He's the Chief Market Strategist at Agora Financial. He's joining us just this morning to help us take a look here. Alan, obviously, I shouldn't say obviously, it does seem as if the focus in terms of the inflation numbers tends to be more on the consumer side of things, because the producer side doesn't always trickle down to us as consumers. But ultimately, these numbers kind of feed into the narrative in terms of what we saw yesterday, a little bit below expectations, today a little bit above expectations, but still kind of mixed news in terms of some of the fundamentals, and ultimately a very muted reaction too.
Yeah, it's a balance here. We still don't have a spark for inflation. Today is maybe the start of something, but yesterday's CPI numbers, what was the big headline that people are bidding up the price of used cars? So,
right.
We need something more here, and I think Stephanie had it right. Until the energy complex gets going again, that can provide some sort of price support for inflationary type action that we want. And crude oil is just stuck at this 40. So it's not good or it's not bad. It just stuck at 40 in this range between 35 and 45. And it keeps pivoting above and below that 40. But I think that is the segment to watch, because that can add to the inflation component.
You sure can. And then ultimately, if we start to see some inflation crop up, then in theory that could impact or could have a ripple effect here. We could see some movement in rates. Ultimately, you would think to the upside. If we started to see inflation, we could see the dollar start to move as well. Let's talk about the dollar, because it's not just crude and it's not just inflation that we're seeing a balance, really. We're seeing that for the most part in the U.S. dollar as well. It's basically been range bound, and Alan, it's in the middle of it right now, the range that we established basically since the end of July.
Yeah, 93. That's it. That's all we need to talk about. Is it going to flip back below the 93 level? We had that fake out breakout where it went above 94 for a few sessions, but then it wasn't sustainable. So we're stuck between 92 and 94. So, my money is still on the trends maintaining themselves. I'm not a trend turn guy. So let's see if we can make another swing to the downside in the dollar. And let's remember, the situation at any time, another bucket full of money could come flying at us. And any sort of stimulus, anything to gather some headlines to kind of change the tone of what's happening in politics right now. So that wouldn't be a surprise. But there are other things to think about. That I did read that the banks in Europe are getting a warning. How would they react if rates went negative? So they're being prepared for that. So again, the battle will continue. The race to the bottom in currencies, and it is a fight, but these trends are pretty established.
Let's talk a little bit about rates here, Alan, and I like what you mentioned here in terms of negative rates in Europe, because we've been talking about that as a possibility quite a bit this week. Seems to be a little bit openness to it, at least in terms of the Bank of England, and some expectations that they actually will cut next time around, potentially the RBA as well. I heard it's very likely to cut. I'd imagine some of this has to do with Brexit negotiations, and then ultimately, Alan, I guess I'm wondering what type of an impact, if the Bank of England, if the RBA, as I mentioned, did cut, could that have on U.S. rates here? Would that just sort of feed into the narrative that, again, lower is necessary still, and potentially even we here in the U.S. should start to think or consider or revisit at the very least that negative rate discussion?
Well, it's not a revisit. We have someone that's very encouraged by lowering rates. And let's remember that lever is still always possible. Anything can happen, especially the last couple of weeks before election in this non-typical environment that we're in. So I wouldn't be surprised if some sort of pressure there, happens to, act as a stimulus here, or just as a headline grabber here, and that could give the markets a bit of a boost. So that's the question. But if you look at the macro market, if you look, the S&P and tech, the NASDAQ, we're within 1% of their all-time highs here just on Monday. So, we've had a big U-turn there. That brings tech, the NASDAQ 100, up 15% from the lows of just 2 weeks ago. So it's been a very quick U-turn after that, that we saw that profit-taking pullback. The same can be said with the S&P. And if you look at tech is still 80% off its lows. So, the macro market strength remains. So like I said, the trends are still intact regardless of what's been happening around here in the United States and around the world. The major events that would have been upheaval have not had any impact on the market. So that's almost as big a news as what's been happening in the last couple of weeks. I
like that because oftentimes I talk about how price inability to go lower is as significant as its ability to go higher. And as you just mentioned, the lack of impact on price activity, whether you're talking about the fact that the market's been able to claw up the wall of worry in terms of trade uncertainty over the last couple of years, and then recently revisited some of that uncertainty. I guess I'm wondering how much of this, Alan, do you think is tied to lower rates, and as we were just talking about, a weaker dollar? Because ultimately, if that shifts, then we could be talking about a little bit of a different narrative if it is dependent on that, or is it just straight up the fact that we're seeing good company results? We were talking earnings at the top of the show. Banks, for the most part, doing pretty well, and
billions.
Again, I mean, is it 100% dependent?
Yeah, bank billions. JP Morgan made $9 billion. Bank of America disappointed. They only made $5 billion for the quarter, and that's pure profit. So nothing's changed there. The big boys got it figured out, even with low interest rates. So if interest rates do, eventually turn, they'll may be making more money. But we've seen interest rates bounce. We bounced from whatever. We went to 4-month highs here in the 10-year note recently. So there is a bit more firmness right now because it had been an overloaded trade to the downside. Let's see if we get another swing down in both the dollar and in rate, and that could be stimulative, and that's the path that we've been on. That could be stimulative for stocks, obviously, and for commodities. So I'm still a believer in these overall directions. Until proven otherwise, I've got to follow that. Now let's see if we can get another leg down now that we've seen a little bit of short covering in both the dollar and in some of these rates.
Good stuff, Alan. We'll continue to watch the fundamentals. We'll continue to watch the dollar and the ripple effect, as I like to call it. It's widespread. Ladies and gentlemen, Alan Nuckman's joining us here this morning. He's the Chief Market Strategist at Agora Financial. Thanks to you, Alan. And ladies and gentlemen, now that we've covered the fundamentals, and we want to dive into some of the